Record losses were suffered around the world earlier today in reaction to Friday's Wall Street drop, which was one-fifth the size of today's.
What happened was the largest drop in the stock market in terms of percentage-wise in the history of the United States before or since. The stock market lost 508 points, which doesn't sound like a lot today, but then it was like 23% of the value of the stock market. That morning, it kind of started out in Hong Kong and moved west, and the markets just kept dropping. And when London opened way down. And then we opened and it went way down and it kept going down. A lot of people attribute the enormity of the situation to what was called program trading. It's when a computer is deciding what you need to sell, and you program the computer that if something in your portfolio goes down X percent, you automatically start selling that. I think if you look at the commentators, most of them will tell you it was program trading and portfolio insurance that caused the problem. But I really think a lot of it was fear because you couldn't get information. Nobody really knew what was happening. They were shorting futures in Chicago on the Merc and trying to hedge it on the exchange in New York, and couldn't get the trade completed in New York and panicking. You know, we're so used today to instant information, but can you imagine? The lack of information just made it so frightening, and I think a lot of people just sold out of panic, and it just kept going down and down and down. First of all, the markets have put safeguards into place. We have circuit breakers that will halt trading if there's too much volume at a loss. Now, in those days, that didn't happen. Number two, trades are completed by computers now, so that you won't have this horrible lag time that just made people more and more frightened. And we have instant access to information about the markets now. In terms of the practice of law, it really changed the practice of bankruptcy law in the United States. You know, prior to then, bankruptcy was considered something kind of dirty, and the fancy firms didn't want to, touch it. Up until then, it had always been the term bankruptcy, and now all of a sudden people are talking about restructuring. So when Black Monday happened, even though the markets recovered fairly quickly, it took a lot of wealth out of the marketplace overnight, and small businesses and medium-sized businesses and businesses that depended on personal guarantees of the founders who suddenly had a worthless portfolio. Those businesses needed help, and they needed time to recover. And all of a sudden people are thinking like, well, maybe we can use this bankruptcy statute, even though we're not bankrupt, we can use it to restructure. And then when people started figuring that out, they're like, all these big firms that would never have a bankruptcy practice, everybody wanted a bankruptcy practice. So if you look at the number of firms that started or expanded their bankruptcy practice in '87 or '88, you will be shocked. So all these firms that never had bankruptcy, now everybody wants to do bankruptcy, and now it's not bankruptcy anymore, it's restructuring.